You were told you need a 720 credit score to buy a house. That is a lie. You were told you need 20% down. That is a lie. You were told you need perfect credit history with no late payments and no collections. That is a lie. People buy houses every single day in America with credit scores in the 500s, with zero money down, with collections on their report, with a bankruptcy in their past. They are using programs that banks do not advertise because banks make more money when you rent. Here are 8 ways to buy a house with bad credit in 2026, including 3 government programs that will literally give you money for your down payment. Not a loan, a gift. Free money towards your house. This is not a seminar pitch. There is nothing to buy. This is just information that changed my financial future, and it can change yours. Method 1. FHA loans. The Federal Housing Administration insures loans for buyers with credit scores as low as 500. 500. That is a score that most people think disqualifies you from everything. With a 500 credit score, you need 10% down. With a 580 credit score, you need only 3.5% down. On a $200,000 home, 3.5% is $7,000. That is your entire down payment. FHA loans are available through most major banks, credit unions, and mortgage brokers. The interest rate will be higher than a conventional loan, typically 1 to 2% higher. But you are in the house. You are building equity. You are paying your own mortgage instead of your landlord's. Method 2. USDA loans, 0% down, no minimum credit score. Most people have never heard of USDA loans, and they are one of the best-kept secrets in real estate. The United States Department of Agriculture offers home loans with 0 down payment for homes in eligible rural and suburban areas. And here is what most people do not realize. USDA's definition of rural includes suburbs and small cities. Areas you would never think of as rural qualify. Towns of 20,000 people qualify. Suburbs outside major cities qualify. Check if your area is eligible at eligibility.sc.egov.usda.gov. There is no official minimum credit score for USDA loans, though most lenders prefer 640. However, lenders who do manual underwriting can approve scores below 600. The interest rates on USDA loans are typically lower than conventional loans because the government guarantees them. 0 down. Low rates. No private mortgage insurance in the traditional sense. If you are buying outside a major city center, check USDA eligibility first. Method 3. VA loans. If you served, you earned this. If you are a veteran, active duty service member, or surviving spouse, VA loans require 0 down payment and have no minimum credit score requirement. The VA does not set a minimum score. Individual lenders do, and many will go as low as 500. VA loans also have no private mortgage insurance, which saves you $100 to $300 per month compared to FHA loans. VA loans consistently offer the lowest interest rates of any mortgage product. If you served and you are renting right now, you are leaving one of the most powerful financial benefits you earned on the table. Apply through any VA-approved lender. You will need your certificate of eligibility, which you can get at va.gov/housing assistance. Method 4. Down payment assistance programs. This is the one that blows people's minds. There are over 2,500 down payment assistance programs in the United States right now. 2,500. These programs provide grants, free money that does not have to be repaid, or forgivable loans that disappear after you live in the home for a set number of years, typically 3 to 5. The average down payment assistance grant is $10,000 to $15,000. Some programs offer up to $50,000. These programs are funded by state housing finance agencies, city governments, and nonprofit organizations. Most require that you be a first-time home buyer. But the definition of first-time buyer is anyone who has not owned a home in the last 3 years. If you owned a home 5 years ago and sold it, you qualify as a first-time buyer. To find programs in your area, go to downpaymentresource.com. Enter your zip code and it will show you every available program. Your loan officer can also search for you. But many loan officers do not mention these programs because they add complexity to the deal. Ask specifically, what down payment assistance programs am I eligible for in this area? Method 5. HUD homes. The Department of Housing and Urban Development sells foreclosed properties at significant discounts. These are homes where the previous owner had an FHA loan, defaulted, and the government took back the property. HUD sells these homes through a bidding process, often at 10 to 30% below market value. Owner-occupant buyers, people who will live in the home, get priority bidding over investors. You can search HUD homes at hudhomestore.gov. Some HUD homes are sold as is, meaning they may need repairs, but the discount often more than covers renovation costs. And you can use an FHA 203K loan to roll the purchase price and renovation costs into one single mortgage. Method 6. FHA 203K renovation loan. This is the loan that lets you buy a fixer-upper with bad credit and finance the repairs. Here is how it works. You find a house that needs work. New kitchen, new bathroom, new roof, whatever. Instead of getting a mortgage for the house and then a separate loan for repairs, the 203K combines both into one mortgage. You can borrow up to 110% of the home's projected after renovation value. So if a house is worth $150,000 after renovations and costs $100,000 to buy plus $30,000 in repairs, you finance $130,000 total with one loan, one payment, one closing. The credit score requirement is the same as a regular FHA loan, 580 for 3.5% down. This is how you buy a house that others pass on because it needs work, fix it up, and end up with instant equity. Method 7. Rent-to-own agreements. If your credit is too low for any mortgage right now, rent-to-own gives you time to build your credit while locking in a purchase price. In a rent-to-own agreement, you rent the home for 1 to 3 years. A portion of your monthly rent goes toward the future down payment. At the end of the lease period, you have the option to buy the home at a price that was agreed upon at the beginning. During that 1 to 3 years, you work on improving your credit score so you qualify for a mortgage. You are living in the home, you are building toward ownership, and the purchase price is locked in, even if the market goes up. Find rent-to-own properties on sites like rent-to-ownlabs.com or homepartners.com. You can also approach landlords directly and propose a rent-to-own arrangement. Many private landlords are open to this because it guarantees them a long-term tenant. Method 8. Seller financing. This is the option that requires no bank at all. In seller financing, the homeowner acts as the bank. You make monthly payments directly to the seller instead of a mortgage company. There is no credit check, no bank approval process, no PMI. The terms are whatever you and the seller agree to: down payment amount, interest rate, loan length. Seller financing is more common than most people think, especially with older homeowners who own their property free and clear and want passive income. You can find seller-financed properties by searching for owner will carry or seller financing on sites like Craigslist, Zillow, and Facebook Marketplace. You can also hire a real estate agent who specializes in creative financing. Here is the truth about buying a house with bad credit. It will cost you more in interest than buying with perfect credit. You will pay a higher rate. You might pay mortgage insurance. Your monthly payment will be higher than someone with a 750 score buying the same house. But you will be building equity instead of paying someone else's mortgage through rent. Every mortgage payment increases your ownership stake. Every year of on-time payments improves your credit. In 2 to 3 years, you can refinance at a lower rate once your score improves. And the home you bought at $200,000 could be worth $240,000 by then. $40,000 in equity that renters will never have. A higher interest rate is a temporary cost. Home ownership is a permanent wealth-building asset. The rate is not forever, the house is. If this just showed you a path to home ownership you did not know existed, subscribe. New videos every day. Real money moves for real people. No fluff. Just the playbook. Hit subscribe, and I will see you tomorrow.